Loss ratio. Loss ratio is something where you determine how much a company is paid in premium versus their losses. So they're usually advantageous loss ratios for a carrier. Once a loss ratio gets into a certain level, it's no longer advantageous. Loss ratio, what it is, how it's calculated. It's an insurance term. Loss ratio is used in the insurance industry, representing the ratio of losses to premiums earned. Loss ratios include paid insurance claims and adjustment expenses. The loss ratio formula is insurance claim paid plus adjustment expenses divided by the total earned premiums. For example, if a company pays $80 in claims for every 160, the loss ratio would be 50. Loss ratio is the losses an insurer incurs due to paid claims as a percentage of premiums earned. A high loss ratio can be an indicator of financial distress, especially for a property or casualty insurance company. Insurers will calculate their combined ratios, which include the loss ratio and their expense ratio, to measure the total cash outflows associated with their operating activities. If loss ratios associated with your policy become excessive, an insurance provider may raise premiums or choose not to renew a policy. If health insurers fail to divert 80% of premiums to claims or healthcare improving activities, they will have to issue rebate to their policyholders. How a policy ratio works. Loss ratios vary depending on the type of insurance. For example, the loss ratio for health insurance tends to be higher than the loss ratio for property and casualty insurance. Loss ratios help assess the health and profitability of an insurance company. A business collects premiums higher than amounts paid in claims, and so high loss ratios may indicate that the business is in financial distress.